One of the things I get to do is I like that the time I spend to think about what's the thought leading. I'd like to share something that I just came across today. What do you think? Is it smart to be optimistic? I listened to Jeff Wilkes' devotional, and he talked about he was always a happy kid. He always expected the best. Now, some people said, he wasn't realistic and he wasn't looking at the details. And I feel like I'm that same way too. I like the best. And it's interesting. Now we've got some research here. It says why it's smart to be optimistic. This came out in the December 2010 Reader's Digest. Number one, 3 different reasons. Number one, feeling well helps when you're not well. It says when researchers look at people who have similar medical conditions, they can predict who's likely to live longer, the one who feels his health is better. Optimism also seems to help buffer stress. The author here says, I've been studying first-year law students for 16 years. That's a very stressed group, and in my most recent study, each time a student's optimism increased by 1 point on a 5-point scale, his immune response to an injected virus or yeast improved by 20%. Number 2, optimism is something you do. Anxiety and other negative emotions are known to be detrimental to the body, especially your cardiovascular and immune systems. And having an optimistic nature seems to protect against those effects. In addition, research shows that people who are optimistic about their future behave differently. They exercise more, are less likely to smoke, and follow a better diet. And number 3, not happy? Don't worry. Happiness is a feeling. Optimism is the belief that aspects of your future will turn out well. Happiness can fluctuate a lot, but optimistic disposition is usually pretty stable. If you're not optimistic, you can try creating a positive events log. Good things happen to everyone, but pessimists often don't take notice. Or instead of trying to be optimistic, do what optimists do. Work hard to reach your goals. Each accomplishment should make it easier to be hopeful about it. Interesting thoughts. Okay, today we're talking about investments. Continuing on, we started with the principles, and then we went to the plan, and then we started about how do you build a portfolio. And I'd like to read an email from last year's student reviews. And it caused me to think. And so one student wrote, he says, the investment portion of this class, and he put in parentheses, not the teacher. So he was nice to me. He says, breeds mediocrity. As a finance elective, this class is dumbed down, built with quick and dirty rules for how to invest and what is best. We don't learn how to think for ourselves, value, risk, and reward, or ask deeper questions. This would be a great class for non-finance students. They could easily invest in some market tracking indexes and watch their monthly contributions add up to $1 million over their lifetime. But is that what we are teaching our finance students? Sure, it's a safe bet, but it seems all too mediocre for me. Teach me how to beat the market, find trends, and discover new methods. Give me something that I couldn't find from another college's personal finance class. What do you think? Scott's laughing. He made 4 comments there. Let me make comments on this. The class is dumbed down with quick and dirty rules for how to invest. Is it really dumbed down? Or do we try to understand principles, develop a plan, build a sleep-well portfolio, and understand our behavior? Is it math, or is it really personal behavior? And then think about it. Are there things taught, quick and dirty rules to invest, or is there experience, logic, and theory behind the principles and plans? Question number 2. Go ahead.
Well, I was just thinking if it was really that easy, just to teach us really something in, an undergrad class, basically. Like,
especially
why wouldn't everyone do it? And then everyone would beat the market, right?
That's exactly. So here's, teach me how to beat the market. Teach me to find trends and discover new methods. Can we realistically do that in 5 class periods? Someone has very high expectations. If it was that easy to beat the market, anyone who's had 5 class periods would be out doing it. Look around and read, especially read what happened with this last Wall Street Journal, the weekend Wall Street Journal. Most investors haven't. And if you really want to learn active management skills, why don't you take some of the other classes, like the 409 class and the 415, where undergraduate students actually manage, we just broke $900,000 yesterday. But realize that it takes not days, but it takes months and years to learn the skills. And then the question, do most finance professionals beat the market? Actually, no. And they make 7-figure salaries. So if the finance professors who make the 7-figure salaries generally don't beat the market, what makes you think that professors do it as well and could teach that? So I managed money for 13 years, and it's very difficult to do the market. Some years we did, some years we didn't. Number 3, give me something I can't find in another school's personal finance class. Does it really matter where knowledge comes from? Are we so myopic that all the good knowledge only comes from the finance core? Or is education the process of learning regardless of where the knowledge comes from? And then his thought number 4, which is the one that I thought was cool. We don't learn how to think for ourselves, value risk and reward, or ask deeper questions. That's the best part of this whole evaluation. Number 1, I have 3 final thoughts. Number 1, hope you realize I'm teaching things which I hope will save you $1 million over your lifetime. However, realize this is only 1 semester. And so what do I have to do? I have to emphasize those things where I think students make the most mistakes and where I think we can add the most value. My goal is to pique your interest in these areas and then have you go and to continue to research. You graduate, but your education is only beginning. Number 2, I hope you'll continue to think for yourselves, to value risk and return, to ask the deeper questions. But I want you to realize, though, although theory is good, theory changes. And so I want you to keep your priorities and your testimony strong and on the most important areas. And then the last one, while there's differences of opinion as to teaching investments, I've tried to make this an applications class where everything here is applied. And to teach the application of correct principles is probably the most important thing that you'll get out of this class. And if you will apply those correct principles, you will be able to accomplish your goals. You know, saving $1 million over your lifetime, that's just kind of a fun one. But having each of you be able to accomplish the things that Heavenly Father wants you to accomplish, to be able to go back and return and live with your families, and basically to come into Christ, these are the most important things that we teach. Thanks. Just kind of an interesting thought. What are the different types of taxes we have? The tax is important. Let me step back again. Anybody here going to going to be teaching tonight or be a mentor tonight at the Money Wise? Can I pass these around? And I still can't find the lanyards, so we just printed up some of these. If you'll take these, and if you might want to take 2 of them in case someone else comes, I'll let you. Just pass those around too. And then the roll's going around. If you need one, just take those. I'd appreciate that. Okay, let's talk about our investment plan assignments. Again, if you'll do, today we're talking about mutual fund basics, and what I'd like you to do is develop criteria that you use to select a good mutual fund. That's what we were assigned to do. So hopefully each of you had your stocks that you were assigned. Using that criteria and learning tool 7, using Morningstar to select assets, I'd like you to pick 1 mutual fund minimum for each of your 4 asset classes. For diversification purposes, I require a minimum of 4 asset classes. And then on selecting assets, using your criteria for good mutual fund, I want you to select mutual funds for each of your asset classes. You'll print off the snapshot page from Morningstar. You'll include the chosen names in your Exhibit 2, Teaching Tool 13, and then you'll assemble your completed investment policy statement and investment plan. So that's what we want to do. Again, our goal is after you finish here next week, you'll know, once you graduate, you'll know where your first dollar's going, you'll know into which funds, you'll know how much you have to put into the funds, you'll know how to purchase those funds, you'll know how to do all of these things. Okay. So, I've got 12 sheets of paper here. You want to take one and just hand one back. Go for groups. Take one. We're going to have 12 groups. We're going to have a little competition here. What are the different types of earnings? Keep these over so we don't look at them yet. We're just going to divide into 12 groups. Have a competition. You can fill this out first. what are the different types of earnings and taxes? I guess what I'm saying is taxes. And I'm going to talk about 2012 taxes here because really, I'm not quite sure on how the changes, what the changes have been made. So what I'd like to know, what we're going to do, well, how are different things taxed? So here is what you're going to fill out. Types of investment. Types of earnings, capital gains, short-term, long-term dividends, bonds and savings vehicles. How are they taxed? Mutual funds, how are they taxed? So let's see how quickly we can do this. So do we understand the question? We're going to get together with our groups and to the accountants. The accountants know. So raise your hand if you're an accountant here, accounting major. These are the people you want to. So what we'd like you to do is let's just talk about this. I'll do the first one for you. How are short-term capital gains taxed at the federal rate? How are they taxed? Ordinary income. How about long-term capital gains? You have 15% if your marginal tax rate is 15% or greater, and 0 if it's less than 15%. How about state tax rate? And right, just assume, since we're in Utah, we'll use that. Basically taxed at your ordinary rate. Is there any differentiation between short and long term at the state level? No. Okay. The record is about, I think the record's about 57 seconds. Okay. We know what the assignment is? Fill it out quick. Let's see how quick we are. On your mark. Get set. Go.
Do you know any of these? Josh? You know some of the answers. Yeah?
For most of you, the good news is everything at the state rate is ordinary. Okay, we're at 55. Anyone beat 57? Okay, let's see who's going to be the first here.
Did it? I'm not sure if it's right.
You did it? You're
Not sure it's right.
Okay.
We put numbers down.
We put numbers down. Let's give people about another 15 seconds, and then you can take this through.
Oh, that's good.
Okay.
We're curious on
short-term. This is your marginal. Just put MTR, marginal tax rate. Okay.
We're assuming we're millionaires.
So MTR. Short time. MTR. Treasury bills.
Black box.
There's state tax. We'll work with it. Okay,
We're counting, but not.
let me ask the question, why is it important that we understand the taxes on different types of earnings? Why is it important? If we don't know the taxes on different kinds of earnings, how can we calculate our after-tax returns? So it's really important that we do this. So there are some questions here. So I'm just going to hand this taxes filled in, and then we'll kind of talk about this. Capital gains, short-term capital gains, those are taxed at your marginal tax rate. What happened in 2013 to marginal tax rates? Did they go up? Yeah, so taxes increased there. A long-term capital gain is where you hold it 366 days or more. So if you're in the 38.6, was it 38.6? Is that the new one now? Something like that. And you instead of you sell it at 365, you'll pay almost 40% taxes. But if you hold it one more day, you'd pay only 15% taxes. Plus, there's some new changes there too. So these are 2012. I need to get all the details for 2013. Stock dividends. What's a qualified dividend? Any idea? Anyone heard that term? A qualified dividend. So basically what the government's, go ahead.
Well, qualified dividends are, they're qualified to be taxed at the capital.
So they're qualified to be taxed at a preferential rate.
Yeah, and then if you have ordinary dividends, then that's just ordinary income tax.
Right, so ordinary dividends are dividends that are taxed at your ordinary rates. So here's I'm just looking at, this is Teaching Tool 32. A qualified dividend is a dividend paid by a U.S. corporation where you held the stock for more than 60 days during the 121-day period that begins 60 days before the ex-dividend date. How did they come up with this? I have no clue. I have no clue. But so what they want you to do, you had to at least, they're trying to encourage you to hold the stock for a longer period of time. So you had to at least hold it for 60 days during the 121-day period that begins 60 days before that. And so here's an example. You purchased the stock on June 28th. It went ex-dividend. What does it mean, ex-dividend? So it's the first day of trading following the announcement of the dividend. So it went ex-dividend. They announced the dividend here on 7/6. You sold the shares on August 1st. You only held the shares 34 days, and so it's not qualified. Now, July 5th, you bought the shares. July 6th, it went ex-dividend. You sold the shares on September 6th. Was that qualified? The answer is yes, because you started 60 days before, and you held it at least 60 days for that period. But do you see that differentiation? So how about it? Does this impact whether it's a mutual fund? If a mutual fund does the same thing, does that impact you? The answer is yes. You'll get a 1099. Is it a 1099-T? I'm not sure which one. Or a 1099-DIV. And it'll actually tell you, these are qualified dividends from your mutual fund. These are ordinary dividends from your mutual fund. And guess what? You have to pay taxes on both of those. But ideally, you'll pay less taxes on your qualified than you will on the ordinary dividends. So we've got capital gains, dividends. How about bonds? Is it the same way, capital gains and dividends? Of course, there's no dividends. But you've got short-term capital gains where they bought a bond and then they sold it. So ideally what you want to do, if you're going to buy bonds, keep them for a longer period. That way if there's any capital gains, you can get the benefit there. How about interest, coupons, and payments? Is that preferential, or is that at your marginal tax rate or ordinary rate? It's actually at your marginal tax rate. So if you had the choice between dividends and interest payments, which pays higher taxes? The interest payments. Now notice, Treasury bill bond interest. Treasury bills, are they state tax or federal tax free? They're state tax free. How about municipal bonds? State tax or federal tax free? Federal tax free. And what happens if you've got municipal bonds from your state?
Tax free.
Yeah. So they're state and federal tax free. So that's kind of the general thing here on stocks and bonds. How do mutual funds handle it? Since they're what?
Pass it on.
They're pass-through vehicles, so it's exactly the same. So if your mutual fund has stocks in it, they're taxed just as stocks. But those taxes are passed through to you, the shareholder. So logically, if we want to reduce taxes, what can we do? So you can invest wisely, we can invest tax efficient, you can invest in things that have low tax rates. What are things that have low tax rates? and municipal bonds, things like that that have no tax, which has cheaper tax rates, long-term capital gains, things that have long-term capital gains. And ideally what you can do is you invest in funds that have very low distributions. Because if they have no distributions, you don't have to pay the taxes until you sell. Okay. Make sense? Let's do a little case study. And this is just from, these are actual funds from 2011. I haven't put any for 2012 yet. So Bill and Sally had the following mutual funds. 25% federal, 7% state marginal tax rates. So we remind you what those tax rates are. How do you calculate the before tax and after tax return on the stock? How do we do that? Let's start with this first one, Fidelity Magellan. Beginning NAV was 71.61, ending NAV was 62.98. And these short-term distributions, long-term distributions, how do we calculate that return? 2012 would have been a much nicer year for the fund because the S&P was up like 16%. So, but how do we calculate the return? What's the formula for calculating before tax returns? Don't everybody speak at once. Matt, go ahead.
Change in NAV plus your distributions divided by the beginning.
So ending NAV plus distributions divided by beginning NAV minus 1. Or you can do ending plus distribution minus beginning all over beginning. So all of those things here. So let's get out your calculators and let's calculate that return on the Fidelity Magellan Fund. In 2011 wasn't a good year. I'm not saying anything against this. Like I said, I'll update these for 2012, which was a much better year. So what return did you get? Negative 11.5%. Now here's the question. So the fund lost money in 2011. Did you still have to pay taxes on those distributions? And so what did that do to your return? Does it make it even worse? It does. So even when the fund has negative returns, you still have to pay taxes on those distributions. How do you calculate the return after tax?
You just multiply the 0.41 times the tax rate?
Right, times 1 minus your tax rate. You do 1 minus, so that tells you how much you get to keep. So your taxes is what you have to pay. So let's talk about this one, Fidelity Magellan. All taxable. So what taxes do you have to pay? Yeah, so you'll pay 25% federal, 7% state, so you'll pay 32%, almost a third of that goes to taxes. So you get to keep 2/3 of this. How about long-term capital gains distribution? What are the taxes on that federal? What, pardon me? 15%, and what are the taxes state? 7%. So 15 plus 2 is 22%. So this would be 0.02 times 1 minus the taxes you paid, which is 22%. So do we get a sense on how to do that? This is probably a good question on a quiz. Just out of curiosity, how would I calculate my total portfolio return here? How would I calculate my total portfolio return? Would I just calculate my weights of my returns on each of these stocks and then multiply it by my percent of the portfolio? It's actually beginning percent of the portfolio. And the answer is yes. Or there's an even better way. You can't do it, use it on the quiz. We could actually, here's just a learning tool 33. So we put in our long-term tax rate, federal marginal tax rate. And the purpose of this assignment here is just to remind you, you know, things like large cap and small cap, these are taxed, fully taxable. When you get into muni bond funds, they are federal tax free, and you have to pay state tax on it. If it's from your state, it'll be federal and state tax free. Question: muni bond funds, are they tax free for capital gains as well, or is it only for interest? What do you think? Is the benefit for capital gains as well, or is it only for interest? Cassie's saying it's for both. What do you think, Scott?
Doesn't depend on how long they've held the stocks that are confined.
Actually, the interest benefit is only, or the tax benefit is only for interest. You still have to pay capital gains, but if they're long term, you'll pay at the lower rate. So, when I first started teaching this, I thought the same thing. I thought they were tax free for interest and capital gains, and it wasn't until a student reminded me that they weren't.
I have a question. I think in one of my other classes before, I learned that before you invest on muni bond, you have to reach a certain tax bracket, because otherwise it will be less profitable. Like it doesn't, like because the interest rate is lower, it doesn't really, like investing in other bonds will be better.
Right. Remember we talked about that equivalent taxable yield. So what we did is we gave you the tools. I think that was about 2 or 3 days before. We talked about, did these instruments have tax advantages? So if we can calculate an equivalent taxable yield, we can say, okay, I have to make at least this return on a corporate bond to be equivalent to this return on a tax advantage security. But the nice thing about this is this gives you a framework. So you calculate your return. Here's how you pay 35, you get to keep 32 cents. So your after-tax return is, or 32% is your taxes. This is the amount you get to keep. And it's just a tool to help you. How often should you be reviewing your portfolio? Should it be every day? How about every month? No, if you have a sleep-well portfolio, and this is the kind of fund that you want to hold for 40 years, yeah, probably once a year. You know, take a look at it. But it's important that you understand that not all earnings are created equal, and not all investment vehicles are created equal. So it's really important. It's really important that we understand. You know, some people are, you know, the email from the student, I should say the class evaluation from the student, he's saying, you know, we should be buying, show me how to beat the market. We should be buying individual stocks, is basically what he's saying. What do you guys think? Is it a good idea to buy individual stocks when the size of your portfolio is small? Why? Why? What principles does buying individual stocks violate when the size of your portfolio is small?
Well, one, they're more volatile.
Much more volatile. If you have a small portfolio, let's say $3,000, how many stocks does it need to give you somewhat of a diversified portfolio? You know, 10 to 15? You know, so that means you're putting $300 in each stock. What's the cost to buy a stock? $10 is $10 to trade. So $10 on $300, you're paying 3-4%. Does that make sense? So, number one, diversification. Number two, invest low cost. Other reasons. Guys, remember you're being videotaped here. Go ahead.
Higher capital gains tax?
Higher capital, yeah. Well, if you held it for long terms, you can get the same benefit there.
We talked about, not trying to beat the market unless you have a lot of time and a lot of money.
Yeah, not trying to beat the market unless you have a lot of time and money. Do you have to invest in individual stocks?
No.
Actually, no. No, other than what I do for the 450 class, I don't invest in individual stocks. So just some thoughts. Violates 5 major reasons. Number one, stay diversified. Picking single stocks violates that principle, especially when you're just beginning your portfolio. With a small portfolio, it's difficult to achieve acceptable diversification. 2, low cost and tax efficiently. And I even, in the investment plan, when you say have a small portfolio, I even put $500,000. Because I generally don't like to buy any stock less than like $30,000 or $40,000. So when you have a small portfolio, it's very expensive. Transaction costs for purchasing stocks are among the highest in the industry. Number 3, know what you invest in. Picking stocks when you haven't developed the skills is really a challenge. And we do not teach you that skill set in this class. Even students in my 409 and 415 class, I mean, that's where they start, I think, building the skills to be able to make those decisions. Most of them not develop the skills. And I don't mean that rudely or things like that, but it's a very narrow skill set. 5, don't spend too much time trying to beat the market. And unless you've got a lot of time, energy, and money, and most of you, you're going to go out and you're going to do your job as corporate finance or accounting or as management, information systems or consulting or things like that. Managing your portfolio is just going to be something on the side. And then the last one too, it's nice, it's intellectually challenging, but research has found you can generally improve your returns more just by properly selecting your asset classes and buying the individual stocks. So just some logic behind what we do. So, questions on why we don't buy individual stocks or why I don't recommend you buy individual stocks. Now realize I teach the asset management class and the 409 class. And sometimes the students, they'll buy individual stocks, but that's part of their education. I call it expensive education. But you'll make better decisions if it's your money. So, but for most people here, I don't recommend it. So, if buying individual stocks is not a good thing to do, then what does that leave us with? What type of financial assets does that leave us with? And mainly mutual funds. Now, someone defined the difference between a mutual fund and an index fund and an ETF. What's the difference?
So mutual fund has like a mutual fund manager that picks the stocks, and basically you're just buying in a portion of that fund.
Okay.
Like an index fund just matches an index.
So it matches an index. So basically the portfolio of the index fund mimics the portfolio of the benchmark.
And then an ETF, is, like you're saying before, is basically a mutual fund or an index, but it's traded like a stock.
Trades like a stock. So it's basically a mutual fund or an index fund that trades throughout the day. I used to manage money for Montgomery Asset Management. And then I was, we had to pay our analysts, we had to put them on planes, we had to send them to Asia, we had to visit the companies, we had to stay in 5-star hotels, we had to fly business class. It was really kind of fun. It was a lot of work. But they had to pay me expensive things. And so the cost of the fund required that they pay the analyst and they pay for the expenses and things like that. With an index fund, do they pay managers to fly all over the world and visit the stocks? No, you've got someone there who's running a computer program that does it. Is that a lot cheaper? Yeah. On my fund that we ran, I think we charged 150 basis points, 1.5%. You can now get emerging markets index funds and you'll pay like 40 basis points or 30 basis points, 0.3%, which is 1/5 of what we charge. So realize that. So what makes a good mutual fund? So if our acceptable financial assets are more index funds, mutual funds, ETFs, we have to be able to decide what makes a good fund. So what I'd like you to do is I'd like you to get into your groups and let's spend a couple of minutes and let's talk about what makes a good mutual fund. Because if we can use that criteria, then we should be able to go and using database programs or things like that, we should be able to do a better job of picking mutual funds. So let's take a couple of minutes.
Unless you're trying to go into
Can I step back just a second? The process to pick a mutual fund is this, and then we'll kind of, I'm just that's one slide behind. Number one, what's the process to pick a mutual fund? Number one, you need to determine your asset class. So we don't pick a stock without picking an asset class. So actually what we do is we pick the asset class first. What do we need? Oh, we need emerging markets. We need international. We need something like that. So determine the asset class needed. Number two, we determine the key parameters for that asset class. What are the principles? Low cost. What are the things? And that's what we're working on right now. Then what we do, using a database program, we set the parameters and evaluate each of the potential candidates. Then once we have our candidates, we evaluate each candidate, select the fund, and then we purchase the fund. So remember, our first thing is determine the asset class needed. And now what we're doing is we're working on determining key parameters for that asset class. Okay, 2 minutes. Sorry about that.
Remember he said,
Yes.
With distribution, so
it was like one of his teammates was like,
Remember, at any time I
oh, okay, so you want to actually
This is like 20 years.
Pretty much just broke even.
And then you never in the summer, it was 30 days. It was high for that few days. And then I was like, oh, I'd pull out to it, and now it's exciting.
Okay, so give you some ideas. So the purpose of the questions here is, if you can tell me the things that we need to make good decisions, to pick mutual funds that we can actually go in and using a program we can pick out maybe not the best funds, but we can pick out good funds. Okay.
We talked about having kind of that long-term strategy just because you don't typically make a lot when you go short-term.
So how can you tell something they have a long-term strategy?
Well, when you invest, you don't want to pull out your, sell out within that year.
Right, so that's when you buy and sell. How can you tell that the mutual fund has a longer-term strategy?
Look at the stocks that they're investing in and how long they typically buy and sell.
So you can look at turnover. So a long-term view, look at turnover. What's better? Do you want a fund that has high turnover or low turnover?
Low turnover.
Yeah, low turnover, because every time they buy a stock or they sell a stock, that's a taxable event for you.
What would be considered a good range for turnover?
Now, will that vary depending on asset class? Okay, so let's talk about large caps. I like index funds just because they're cheap. What do you think turnover is on index funds? How often do they turn over the portfolio? And basically any time part of the index changes. So turnover for a large cap index fund would be somewhere from 2 to maybe 9%. So single digits. How about bonds? Does turnover matter very much in bonds? Probably not, because it's all taxed at ordinary rates anyway. So bonds, I don't, why is that turnover? How about something like small cap? You know, it might be a little bit more for small cap. Emerging markets probably like it might be a little bit more. But I like things that are less than, if you can see your turnover ratio, if it's greater than 33%, remember you take 100 divided by your turnover ratio. So if it's 100%, they're turning it over every year. So all of it's going to be ordinary income. So just be wise on that. But I like things that have turnover ratios less than 50%. For index funds, I like it less than 20% or less than 10. Other principles, other things that makes a good mutual fund. So we've got turnover, and that's a proxy for taxes. So we want low taxes. Austin.
They're consistent with like stuff.
Consistent. Anyone heard of a term called style drift? Style drift means that, and we'll talk about this in a minute. So here's large, mid-cap, small. Here's value, here's blend, and here's growth. Do you want a mutual fund 1 year is large blend, and next year is small value? No. Do you want them to change that asset class on you? And the answer is no. So you don't want style drift. Okay, other things. Yes.
Just like we talked about the other day, low fees, like no load funds, always good.
I had a student from my MBA class came into me yesterday, and he says, you know what, I was down to this bank, and he said, this was about a year ago, and I asked him, you know, I was thinking about putting an IRA, and they showed me some funds, and so I've got this fund now. And I said, well, did you pay a load on it? He goes, I don't know. So we went back in there, and he had paid a 5.75% load on this fund. And not only that, this fund charged management fees of over 100 basis points a year. And so he goes, well, I didn't know. And so when you talk about fees, low fees, do you want to pay a load? Which is, do you want to pay a sales charge for the privilege of being in that fund? What has research found? Do load funds outperform no load funds? The answer is no. How about, do you want to pay a 12B1 fee? The 12B1 fee is the fee that you pay so the mutual fund has the privilege of marketing that fund to someone else. Do you want to pay a 12B1? This fee also had a 12B1 fee on it.
Why are back-end loads generally more acceptable?
Okay, a back-end load. Now, I don't mind a back-end load too. I was managing money at Montgomery Asset Management. We had an emerging markets fund. And what happened is we would have days, we would have $50 million coming in one day. And the next day, $40 million would go out. So we had what we called this hot money. And you know, trying to invest that money and then having to sell it again when the money went out was tough. And so we put a 90-day back-end load on it. that if you had the shares less than 90 days, you'd have to pay this load, and that would go to the fund and not to the managers. And so what it does, it just gave me a little bit more stability. Are we long-term investors or are we short-term? Long-term. So a back-end load, I don't mind, because I plan to be there for a long time. And so a back-end load of less, maybe a year is probably, I don't have a problem. So we want low fees.
I mean, is there any way to distinguish? I mean, so let's say we go in and then they show us, the contract returns. And,
right.
I mean, do they have to explicitly say it's a 12B1 fee, or can they?
Yeah, they will actually say that. And I just brought a bunch of annual reports. I hate to say most of these are Vanguard just because that's what I had at my house. I got Vanguard and Schwab and some other things here. But if you want to take a look at some of those, you're welcome to do these. Some of these are older than others. Actually, I was cleaning out my desk at home, cleaning out the office, and that's where it came up, and I thought those might be good. But go inside there, you can look. They've got different classes of shares, things like that. So other things, what makes a good mutual fund?
There's a large amount of money in it.
Okay, do you want certain asset size minimum? Generally, if you've got a small mutual fund, do you get the economies of scale? And then also realize small mutual funds, you might have higher returns because you can invest in things. But generally, if we're going to be around for 40 years, you probably want a larger mutual fund.
Are there economies of scale just because a bigger fund has more managers and they have the knowledge? Or just the history of
you'd probably look at more the mutual fund company. Like Vanguard is just the gorilla of index funds. They might have some small funds, but what you want is a mutual fund that will be around for 40 years. So when I'm buying it, I'm not buying it just so it'll go up and then I'll sell it. No, I'm putting my money in. I want it to be around for 40 years. I want that sleep well portfolio that we've talked about. So I can wake up in the morning and I don't care. As long as it's generally continuing to go up, I think we're okay. Other? Yes?
Depending on your risk tolerance, you want one with an appropriate beta.
Okay. You could actually, beta, which is basically your volatility. Now, are we concerned with the volatility of each individual fund or more with the volatility of the overall portfolio? Yeah, overall portfolio. But you can't. It's probably a good idea. Let's say an S&P 500 index fund. What's my beta there? Beta to the S&P 1. I've got a Russell index fund. What should my beta be to the Russell 2000? 1. But you want to watch that, especially when you get in some funds that aren't index funds. So watch your volatility. Other things. Let me just add a couple of things. How about cash? Ever heard of a term called cash drag? When I was a kid growing up, I had one brother who took a 4-door Corvair and chopped 32 inches down the middle, shoved it back together, sold it to another brother who blew the engine in back, and he put a Corvair engine in front. So he used to race. What does cash drag sound like? What's the drag here? It's not the drag race.
Well, it's when you have cash that's not earning any sort of return or whatever, so it's just taking up useless space in the portfolio.
So if you this is a large cap fund and you've got 15% in cash, that's 15% of your portfolio that's not earning the returns that you want. Do you want to let the mutual fund managers manage cash, or do you want to do that yourself? You want to do it yourself. So if you have a lot of cash, that impacts the return. How about tracking error? Anyone heard that term? What's tracking error?
It doesn't follow the index.
Yeah, how well it follows the index. Do you remember we said you don't pick an asset without picking a benchmark, and the principle is you compare it against returns. Do you care if there's positive tracking error? Yeah, I just don't want negative tracking error. Positive tracking error means you did better than the benchmark. Let's see, anything else? We talked about views, consistent fees, minimum, turnover. Let me just share 7 things that I think are important for mutual funds. And we'll just hit it quickly. And then I also printed off I took the Morningstar report so you can actually see where you find this. It was really fun for that student yesterday. We printed off his Morningstar report and I just showed him where each of these 7 things were. So diversification. You want to be diversified at times. Remember where you are in the hourglass. I would encourage you to avoid sector funds because they're just so narrow. Individual concentrated portfolios, avoid individual stocks, especially when you're starting out. So where do you find diversification? It can be diversification by numbers. It can be diversification by the types of holdings. It can be diversification by your geographic location. It can be diversification by your sector holdings. So here, this is the S&P 500 fund. Notice how many stock holdings? 502. Notice assets in the top 10 holdings. Why is that important? Why do I highlight that? So assets in the top 10 holdings. The reason I like this is because I take that 18.5% divided by 10, and my largest assets roughly is about 1.5% of the portfolio. How much research do I have to do on a stock where my largest stock is 1.5% of the portfolio? Probably not enough. 2, low cost. And I recommend no load mutual funds. Rear end loads are okay. And what you want to do is you want to keep management costs among the lowest in the sector. And where do you find costs? You can find your expense ratio. You can find also on your sales fees, loads, and other fees, administrative management, 12B1s. So now, I like this here. So here's the expense ratio. Here is the category average. So this fund here has an expense ratio of 18 basis points. The category average was 115 basis points. So if I can see here versus that, am I doing pretty well as far as on cost? Yes. And now we can see fee level compensation group median. So I'm paying 17 basis points. The average is, category is 118. The group median is about 99. So is this a pretty low cost fund? And the answer is yes. So here's my expense ratio. Here's in my prospectus. Here's my management actual and management maximum. So what are they? So they're saying it's 17 basis points. What are they actually charging right now? 14 basis points. Tax efficiency. How important is it to be tax efficient? And again, this gets to your turnover. And we can actually go and we can see how taxes impact the fund. Jared.
I noticed with tax efficiency, whenever you have its fund, usually they're not very tax efficient because you have people like actually considering taxes as they do it.
So are they not tax efficient or they are?
I feel like a lot of them aren't because they just automatically go in and do the trades and stuff. You know?
So let me ask a question. How often do they go in and do the trades? When do you have to turn over that portfolio?
Is it the portfolio? Or
yes.
Is it,
so index fund is a portfolio of 500 assets.
Yeah, but is the assets inside, because aren't those being traded all the time?
Actually, are they being traded or are they only traded when the benchmark changes? So are new names added? Let's take a look at this. This S&P 500 is an interesting index fund, so let's take a look at that there. So it's not what you earn that keeps after taxes. So where do you find it? Pre-tax return, tax-adjusted return after taxes, and then they have a tax cost ratio. Assume people are taxed at the highest ratio. So let's look here. So here's our pre-tax return, tax-adjusted return. What do you notice the difference between those numbers there? 13.9, 13.97, 5.15, 4.69. Do index funds trade much, or should they trade much? Theoretically, they should. And then what you want to do is look, notice here, here's the percent ranking category. Of all of the large cap funds, they're in the top 20%, top 16, top 19, top 23, 22, 31, and 20. So here's an index fund, and yet they're beating 80% of actively managed funds. What does that tell you about tax efficiency of index funds? Or at least this one here. And then turnover. Again, turnover is a proxy for taxes. Where do you find turnover? Look under portfolio holdings, and then you can also look at the category average. So here, turnover for the S&P 500 fund, 3%. The category average was 47%. So what does that tell you about that? Does this help explain the tax side here? So index funds shouldn't turn over very much at all. about low uninvested cash? Again, we want to keep cash low because we want to make that. So we can find the percent of cash in the fund. Here's the S&P 500, 0.23%. Now realize 0.23% is probably $1.5 billion in cash. But this is a huge fund. So we want to watch that. So just watch that cash. When I used to manage money, we used to keep cash at somewhere between 1 and 1.5%, just for inflows and outflows. Because what you don't want to do is you don't want to have to sell your best assets just for people leaving the fund. And then we have what's called style drift. And that is, we want to make sure that we're following the asset class that we want. What we don't want is someone to be a small cap manager this year, and next year to be a mid cap, and the year after that to be a large cap. That's not what we pay managers for. And so here's kind of the old one, and here's kind of the new one here. Remember we said here's your value blend growth, large, mid, small, and now we've actually made it a little bit better, a little bit bigger. But it's still kind of the same thing. So this is blend, value, blend, and growth. And so it kind of gives you a sense.
So why don't we want them to have style drift? Like that makes sense intuitively.
Okay, why? Why does it make sense intuitively?
I don't know. It just seems like you would want them to stay consistent, but I don't know why.
Why would you want to allow a manager to one year decide, okay, I'm a large cap manager this year, and next year I think the opportunities are better, and that's all. Aren't we setting up asset classes? Should we decide who manages the assets, or do you want the manager to do? I think if you only have one fund, you know, like a hedge fund, you could say, okay, you could be opportunistic, you go where the value is. But you're going to be setting aside 20% of every dollar you make after college. You got a comment there, sorry.
Oh, no, I was just going to say the same thing. Like we can diversify our portfolio without them trying to diversify everything for us.
Yeah. And what makes you think that they can diversify better than you can?
Plus, it's kind of contrary to the sleep well fund. I mean, you've been moving it around, and you're going to have to monitor and make sure it's aligned with what you want.
Right, I like that. Do you want to have to keep monitoring? Oh, this is a small cap this year, and next year it's a large cap.
Change all my other investments.
Yeah, you have to change all your investments.
Okay.
Ideally, you want a mutual fund that will follow the asset class. We had another comment here. Sorry. Yeah, so you don't want that style drift. And so what we want to do is, here, look at here. So here's this holding style ownership zone. And notice, has this style been consistent?
Yeah.
You can. It has. And so that's kind of what we want to do. And then last one, tracking error. Actually, the smaller the tracking error, the better the index fund. However, you don't complain if the tracking error is positive. Yes.
I was going to ask, what's the difference between the value and the growth?
Okay. The way it's calculated is this way. They take the PE of the stock divided by the PE of the market, and that gives you a number. So let's say it's PE of 20, and the market, just to make it easy, let's say the PE is 10. And then they take the price to book value of the stock divided by the price to book value of the market. So, and then they add those together. And anything less than like 1.6 is considered a value. The assumption is if your PE is less than the market, it's a value stock, so it's cheaper than the market. If the PE and price to book are greater than the market, it's considered a growth stock, and eventually they think the PEs will come down as the stock continues to grow. So it's kind of an arbitrary thing, but it's one way to look at it. And so you can have growth portfolios, which have low PEs, much lower PEs, and price to book much lower than the market, and then you can have value portfolios lower, and then growth portfolios. So, and what do you think outperforms over the long term, value or growth? Actually, value over the longer term is outperformed, but there are periods when growth outperforms too. So that's the nice thing about blend. You know, we're right in the middle, so we benefit there. So tracking error, where do you find tracking error? Plus or minus the S&P? You know, so if you're doing a large cap, you'd look at plus or minus the S&P. Plus or minus the category is probably more important here for most of us. So for categories international, how did we do versus the average of all the international funds? And then I like this percent ranking category. Number is in top percent. The lower the number, the better. So if you're 10%, you're in the top 10% of all funds in this asset class here. So look at, again, this is an index fund. plus or minus, here's the index fund, S&P category, so plus or minus the S&P. Notice, is there a big difference there? Notice it's about the same as their management fee. Notice though, plus or minus the category. Outperform, 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 under, out, under, out, under, out, out. You know, so again, back to our question, why are index funds outperformed? And that's why index funds came around. Because most active managers underperform. So, questions on what makes a good mutual fund? So let's go. Remember, we asked each of you to come up with your funds. Grab your pencils because we're going to take a look at these. We don't have a lot of time. Let's spend about okay, let's start our group here. What? Give me your ticker.
CNPFX.
C, N as in Nancy. PFX.
Yeah.
American funds. Now, what do you notice about this here? 529 plan. So if the fact that it's got a 529 there means it's only for educational investment. But let's look at it anyway. So there's a couple of things. Why do you think I want you to print off that cover sheet? Load, no load. Expenses 0.67. And this is large growth. So fee level low. Turnover 16%. Is that good? Yeah, that's probably not bad. Status, it's open to new investment. Minimum investment is $250. So risk versus category, return versus category. So we can actually see, generally with large cap, I guess you can decide if you want to do a large cap growth. So generally, let's take a look and see how it's done. How much cash? You got about 6%. What's the size of the fund? 46.4 billion. You got. They may be just in the middle of doing some transfer. So there are some concerns there. Let's take a look at the portfolio. How diversified is this portfolio? We're going to take a look at holdings. So they've got 200 holdings. Assets in the top 10, 18.5%. So divide 18.5 by 10. So the largest one is like 2%. So this would be a good one. So you've got stock holdings. I have no idea what the 59 other holdings are. Here's your performance. Let's look at our fees. So we can look, has there been any style drift here? Actually, no. And so percent of equity, numbers there. So we can actually see, they even give you information on stock portfolio versus the category average and things like that. Yes?
Quick question. If you scroll up a little bit, it says that they have some in non-US stock. What would that be? Would that be international stuff, or would that just be...
Now, notice, here's a question. Category, this is world stock. Investment style, world stock. Do you actually want, what's the difference between international and world? International stock and world stock. What do you think?
World includes the US.
World includes the US. Do you actually want a world fund, or are you going to cover US through your large cap and your small cap and other things here? So generally, I'd recommend you to use an international fund here. So this one, 529, so it's only for education, but generally they'll have other funds, but very similar ones. So turnover performance has been okay, a little bit high on the cash level. I like the minimum investment. low expenses. We could probably do a little bit better, but it's still not a bad one. And just make sure, because this one you couldn't invest because it's a 529. Okay, let's go to the next one. Next one was REIT. Don't everybody speak at once? Anyone come up with an REIT fund? Okay.
Can we do this international one really quick?
Pardon me?
Is that international?
Yeah, the international was the first group here.
Oh, that was
Okay.
Yeah, but that was world, and you probably went international. Let's look up one, just to do another one for international.
I have one for international.
Pardon me?
You
Well, let's continue on. How about a REIT? Did anyone do a large cap? What did you do, Matt?
I think it's a large cap. It's SWTSX.
SWTSX.
TSX.
And let's take a look at this one. Schwab Total Stock Market Index. I like this one. Now notice, okay, first minimum investment 100, status is open. Turnover 3%, do we like that? Are we going to pay much taxes on this fund? No. The expenses, 0.09%, 9 basis points. So that is very low. That's even lower than the Vanguard one. Total assets, 2.5 billion, yield 1.97%. So very good. Here's another one here. Let's look at portfolio, and I'm just going to do holdings. 2443 holdings, almost 2,500 holdings. Assets in the top 10 holdings, 16.51. So your largest assets are roughly 1.6% of the portfolio. How much research do you need to do on this company? So low cost, low turnover. Let's kind of take a look at, let's look at performance. So plus or minus category. Notice, outperform, outperform, out, under, out. Is this a good fund? Now what's the difference between a large cap and a total market index? Total market index like this, let's say the S&P 500 and the total market index. Total market index includes what? Other than more stocks, but includes some small cap funds as well. So over my lifetime, I bought a whole bunch of S&P 500. If I had to change it again for my kids, I'd probably do the total market index here. And so I think this is a good one. I actually have the equivalent, the Schwab fund. Now let's look at, so large blend. Look at those numbers there. So top 13%, top 18, oh, top 42, top third, top third, top third, top third, top third, top third. So here's an index fund that's in the top third of all large blend funds, and it takes no brains at all. So, you know, and we're talking after the fact, but it's still, you know, I mean, hopefully you're seeing that, you know, show me how to beat the market. Wait a second, in this case here, this fund is beat the market. Well, at least plus or minus the S&P 500, look at that. It's actually beat the S&P 500. Why is that though? It says it's beat the S&P. Does the S&P include small cap stocks? No. And this one has a total market. So we probably should have a little bit different benchmark, because it's really part large cap and part small caps. But the point here is, no, we don't have to spend a lot of time, and yet we can get good returns. And that's what we're trying to do. We want you to build that sleep well portfolio, so you can wake up in the morning and you're not worried. Okay, let's go on. Let's go. How about, is someone doing emerging markets fund? Which one?
ODVYX.
ODVYX.
V.
ODVYX. Oppenheimer. We used to compete against these guys. Again, minimum investment 0, turnover 20%. Is this an index fund? Probably not. They're a little bit more active management. Yield below none. So large growth stocks. Let's see how they've done versus the benchmarks. First of all, let's look at some portfolio and see how diversified they are. 119 holdings. You know, top 10 holdings, 22.6, so about 2.2% in the largest. They're still pretty diversified. I don't know what the other holdings are. Let's kind of look at performance. How have they done? Ranking category. Tough year. Tough year, tough, but doing well. Not quite so well, but still, probably not a bad one. You know, and the key, the really key we want to look is now let's look at expenses. So they're closer. They're 108 versus 174. 103 versus 166 and 132. So they're a little bit cheaper on the fees, but they seem to be doing okay. Got another. How about a small cap fund? Did someone come up with that? Which one did you get?
FSCRX.
FSCRX. Fidelity Small Cap. Status limited. I don't know what that means. Whether you could go minimum investment, a little bit higher minimum investment. Turnover 20%. I like that. Fee level below average. Expenses 1.07. 5.3 billion. So we can actually see. So notice it is small cap core or small cap blend is what we want. Let's take a look at a little bit on portfolio. How many stocks do we have here? Well, I've got 1 minute. So let's kind of summarize what we talked about today. We talked about mutual funds. We talked about mutual funds and index funds and ETFs. And actually, all three of those are basically mutual funds, but one trades once a day, which is mutual funds trades once a day, and ETFs trade over the line. But there are advantages. We talked about the reasons we like mutual funds. Just because when we started off with small portfolios, we talked about how to calculate mutual fund returns. Taxes, you need to understand earnings and how those earnings are taxed, because that has an impact on how you do. We talked about the cost of investing in mutual funds, and we filled out that form. We talked about picking financial assets, how you shouldn't be picking financial assets when your portfolio is small. And I actually say roughly around $500,000. You guys you can differ with me on that, but it violates certain investing principles. Buying individual stocks when your portfolio is small violates diversification. Invest low cost. Know what you invest and don't try to beat more. And then we talked about where do you find information. We talked about what makes a good mutual fund. And then we use that criteria to come up with individual stocks. And finally, we reviewed some of the stocks you guys did. Each of you are going to have to pick 4 different asset classes, and then you're going to have to pick a mutual fund for each of those asset classes. Okay, questions? Does that make sense? Thanks, everyone.